Corporate issuers, organizational forms, corporate issuer features and ownership, a very short and sweet chapter. Majorly discussing 4 types of businesses. Sole proprietorship, where you as an individual are operating under the same PAN, your business is operating as the same PAN as your individual. What is PAN? Permanent account number. Okay. Then it was general partnership. Then it was limited partnership. What was the difference between general partnership and limited liability partnership? In limited liability partnership, liability of one partner, any one partner could be unlimited, rest of the partners will have limited liability. But in general partnership, all the partners have unlimited liability. Now, in limited liability partnership also, this differs from jurisdiction to jurisdiction, and some jurisdictions, in order to attract businesses and all, they could allow limited liability partnerships in such form that all the partners have limited liability. So to create a better business and working environment like that. And then comes most complex form, which is corporate. PAN of the corporate would be different as compared to PAN of the owners, who are the shareholders. Now, when it comes to partnership structure, as a partnership, whatever profits I earn, I have to pay tax on it as a partnership firm under the PAN of the firm. Okay, now after paying the profits, whatever is the leftover will be distributed to partners as their share. Do partners have to pay tax on that? No, otherwise it will tantamount to double taxation. Fortunately, the partners don't have to pay tax on that. This is the India specific treatment I had discussed, taxation treatment. It may differ from jurisdiction to jurisdiction, but it doesn't make sense to tax the partners on their share of profits, because partnership firm already has paid tax on those profits. But corporate, I had told you, there is some element of double taxation. Now corporate will pay tax on the profits, and then when corporate gives you dividends to its shareholders, that is from the after tax profits, shareholders also have to pay tax on that in India. Again, telling you, differs from jurisdiction to jurisdiction, but in India there is double taxation on corporate earnings. Okay, fine. Private companies, listed companies, I need not discuss that. Okay, now if a private company wants to become a listed company, it could either come up with an IPO, initial public offering, and in initial public offering, to be more specific, I had discussed there could be some element of additional issue, new issue of shares, or the promoters could come up with an OFS, offer for sale, or direct listing. So no OFS, no additional issuance of shares, just that shares were private, they have been converted to public, they have been listed, that is direct listing, without raising any additional capital or selling any existing stake. And the third one was SPAC, special purpose acquisition company, where a private company compulsorily has to be converted to a public company once the SPAC acquires that company. SPAC is also called as what? Blank check company, because at the time of issuance of shares, when the SPAC issues shares, it does not know which companies and all it is going to buy, right? Okay, fine. So this was all about the first chapter, very small, as I said. Okay, yes, no, it's simply like the shares were private so far, it could not be traded easily. Private shares, if you want to buy and sell, you have to do it through a dealer. Now since they've been listed, you can buy it and sell it on the secondary market, like that. You can buy it from the promoter may list his shares, like that. Okay, fine. Okay, investors and other stakeholders, next chapter. Now discussing about stakeholder and shareholder theory, which is a broader concept. Stakeholder is a broader concept. Shareholder matlab only the owners of the company, and mind you, by shareholders we mean only equity shareholders, don't include preference shareholders here. Stakeholders could be debt holders of the company, government, employees, suppliers, customers. So many people are interested in the functioning of the company. Government, because it wants to collect its fair share of taxes. Employees, because their livelihood is dependent on that company. Suppliers, because they also get business from the company. Customers, because they might be enjoying the company's products, might be dependent on the company's products. So customers, so stakeholder theory is a much broader concept. Now between different sets of stakeholders, don't you think there could be conflicts of interest? Shareholders and debt holders could have an inherent conflict of interest. Shareholders want the company to take on more risk, but it is not necessarily in the best interest of debt holders, because debt holders will say, okay, what I have to do with company taking on more risk? I am to anyway going to get limited returns only in the form of interest. The extra returns could be enjoyed only by equity shareholders. Okay, fine. Now between shareholders is one such category which will have dispute with other stakeholders. Shareholder and employees will have what kind of dispute? Again, it's with respect to risk only, risk taking. Employees would want the company to take on less risk because they want their jobs to be safe, but shareholders would want the company to take on more risk because they are not shareholders only in that one company, they could be shareholder in multiple companies. The same risk factor applies in case of suppliers versus shareholders also. Suppliers want the company to take on less risk so that the company survives and the suppliers can do business with the company. If the company takes on more risk, what if the company goes bankrupt? The suppliers will lose business. But taking on more risk means increasing return on equity, which is in the shareholders' best interest, like that. Getting it? So from the risk angle, you can consider everything. Now, taking on debt, it seems risky, but if you take an optimal level of debt, what is the benefit? Your return on equity increases. But guys, taking on leverage, taking on debt is a double-edged sword. If your business does well, return on equity increases. But if your business reports losses, your downside would be even more than the losses, because you have to meet the fixed interest cost of the debt holders, right? Okay, fine. Now between public debt holders and private debt holders, I can take the example of banks and all. Public debt holders means you bondholders who are having the bonds of company, those bonds which are publicly listed. Who would be having more information? Who would be privy to more information as public debt holders, bond holders? Do you have info about the company? No, you do not have insider info about the company. You do not have detailed info about the company. But a bank, a private debt holder would have. Bank otherwise won't sanction the loan only. The company is approaching the bank, the company is in need of funds, so the company has to disclose all the details to the bankers, then only the bankers would grant the loan. So banks would be more likely to have info about the company, like that. Then we had discussed about the board of directors, 1-tier board structure, 2-tier board structure. Which one is better if you ask me? 2-tier board structure, where the functioning of the executive directors, non-executive directors and all is being monitored by another group of directors, another set of directors, which consists of the chairman, independent directors and all, to oversee the functioning of the day-to-day executive directors, like that. Then talking about staggered board. Staggered board was what? That board of directors, it is difficult to change the board of directors all together at once. You have to wait for some years until the entire board of director is changed. Right? Okay, fine. Talking about statutory voting, cumulative voting, was that concept there for you, or have they omitted that concept? Statutory and cumulative voting, we did not come across that concept anywhere. I think it's no longer there now. Statutory and cumulative voting, it's no longer there. So that's a part of equity. I'm talking about corporate issuers, it's not. We'll discuss it in equity then. Okay, fine. Now talking about ESG, environmental, social, governance. So many examples we had taken pertaining to ESG. Nowadays investors are focusing more and more on ESG factors. Gone are the days where investors were only money minded and used to focus only on returns. Now the analysis extends much beyond that. I had given you the example of Amundi, how it sold SBI bonds and all because it was financing Adani's Carmichael coal project in Australia. So that was an environmental concern. Okay, fine. Stranded assets and all, you remember? The assets becoming useless because of some environmental laws and regulations. I had taken the example of Tuticorin plant of Vedanta. It has now become a stranded asset. It's no longer in use, like that. Okay. Now corporate governance, discussing about corporate governance. Basically corporate governance is what? The way in which a company functions. Corporate governance naturally has to be of the highest standard so that the chances of fraud and all are the lowest. And that is ensured in multiple ways by keeping the internal controls of the company strong. Internal controls, stronger the internal controls, lower are the chances of frauds, like that. And effective corporate, stronger the corporate governance, what impact does it have on cost of capital of the company? Will the cost of capital be more or less? Say for example, I am a company, my corporate governance is very strong. Do you have that much risk as stakeholders of the company? No. So you will be okay with low returns also comparatively, like that. So my cost of capital would reduce, but the shadier I am as a company, the cost of capital would increase, because you are taking on more risk by investing in my company. So naturally you demand more returns. Now I had taken the example of your college fest to explain the concept of committees. Okay, committees in case of companies, which committee is compulsory? Audit committee. In case of financial services company, risk management committee and all are compulsory. Apart from that, there are several other committees which depend on the size of the company. Larger the size of the company, more the number of committees. This nomination and remuneration committee, that committee is responsible for deciding the pay packages of the senior directors, managers and all that. Okay, but mostly it consists of independent directors, because I had told you the reason. I am only the executive director, I am only on the NRC, I want a package of 50 CR, so that could be a problem. Then there is CSR committee, corporate social responsibility committee. Legal committee could be there. So where do you find all such committees? If at all you want to know, okay, what all committees are there in a particular company, where do you find it? In the annual report of the company. You can find everything in the annual report of the company, which all committees are there. By the way, who all are members of this committee? The directors, some people from board of directors only, or any outsider? People from board of directors only. Remember the college example I had told you, in your college exam fest committees, are outsiders there in your committees? You college going students only are there. So similarly, those who are part of board of directors, they themselves are part of the several committees. Can a person be a part of more than one committee? Absolutely allowed, not a problem. Yes, then audit committee, what is the major role of an audit committee? To propose auditors. Appointment of auditors, remember, is always done by shareholders, the owners of the company. The audit committee simply proposes that this audit firm is a good candidate to conduct the audit of our company, like that. Then auditor, whenever they have any issues, any doubts, any queries when conducting the audit of the company accounts, then they ask the audit committee. Audit committee addresses those issues, like that. Okay. The role of legal committee, of course, is to look after the legal matters and all that stuff. Fine. Now talking about AGM, annual general meeting, routine matters are discussed at the AGM, like appointment of new auditors, appointment of directors, reappointment of auditors, reappointment of existing directors, like that, which require a simple majority. Simple majority is what? At least 51% voting. There are some matters which may not be routine and may require super majority voting. Super majority could either be 67%, that is 2/3, or 3/4, 75% voting. Now you don't have to remember all that, but that will be mentioned in the company law of a particular country, that which matters require super majority vote, which matters require simple majority vote, all those things. Annual general meeting is conducted annually, okay, where the audited accounts of the company are presented. Company will have to give advance notice to the shareholders prior to conducting the AGM. As regards EGM, extraordinary general meeting, it can be conducted as many times as the company wants to discuss some extremely urgent and important matters, right? Okay. Now talking about voting, if for example you are the shareholder of the company and you are not able to attend the AGM, can someone else vote on your behalf? Yes, a proxy can vote on your behalf. I had discussed two types of proxies: discretionary proxy, directed proxy. Discretionary proxy means you are telling the proxy to vote in a manner as the proxy may deem fit. Directed proxy is a voting in a way that you have instructed the proxy to vote, right? Okay. Can the proxy suddenly go to the AGM, or do you have to inform in advance? Inform in advance. The proxy could be your friend, any family member, investment advisor, anyone could be the proxy. Now, linking this a little bit to ethics, say for example, I am your investment advisor and you have assigned me as the proxy because I am managing your funds. You don't have the time to go to the AGM and discuss the matters and ask. You don't even know what is going on. So, I am your proxy. Should I vote in your best interest or my best interest? Investors' best interest I should vote in, right? Okay, loyalty of 3A, standard 3A loyalty. Okay. Fine. Creditors committee. Now creditors committee comes into the picture when the company usually is going through bankruptcy. So creditors committee, there will be group of there could be several creditors of the company. Now they appoint a head to oversee all the creditors related matters. So basically whatever the company, whatever assets the company sells, how much money is getting recovered, how much is to be given to which creditor, all that is decided by the committee of creditors, right? Okay, fine. Anything else in this chapter? Hostile takeover. Hostile takeover is what? See, first is tender offer. I am approaching the existing shareholders of the company and offering them to buy their shares at a particular price. Usually tender offer, the price which I offer in case of a tender offer is more than the prevailing market price. Otherwise, you won't be incentivized to offer the shares to me, right, in a tender offer. So I give you some premium as compared to but still if you are not agreeing, then I'll be forced to undertake a hostile takeover. Now without your permission, I'll go on acquiring shares from the secondary market. Now it will be you only who will sell, but you don't know who's the buyer. Samne. You will come to know after the fact. Okay, hostile takeover. Twitter example we had taken. Now to prevent hostile takeover, what does the company do? Issue a poison pill, issuing shares to shareholders at a discounted price such that the hostile takeover, the acquirers stakeholding gets diluted, right? Okay, fine. Activist shareholders, so we had discussed that in portfolio management. In hedge funds also we had discussed activist shareholders. Same concepts are getting repeated. Okay, now working capital and liquidity, a very practical chapter. Working capital and net working capital, two things very important in the functioning of any business, moreover related to the day-to-day functioning of the business. Working capital is what? Current assets minus current liabilities. Net working capital may say, net working capital, if you want to calculate net working capital, exclude cash and marketable securities from current assets, because that is not the money which has been blocked. In net working capital, you only take that money which is blocked somewhere, like debtors, inventories, prepaid expenses, that stuff. And in current liabilities, take everything except for short-term debt, because that is not your money blocked somewhere, right? I mean, you have not blocked someone else's money as such. You take only that thing where you have blocked someone else, like creditors, outstanding expenses, all that. Your working capital usually should be positive. Your current assets should exceed the current liabilities, right? And in terms of ratio also, if you see the liquidity ratio, one of the liquidity ratios was what? Current ratio, current assets upon current liability. What did I tell you? At least it has to be equal to 1. Now, I cannot comment honestly whether higher the better or lower the better. I'll have to dig deeper to analyze, because if the current ratio is say 6 and most of it is situated in inventory, is that desirable, having so much of inventory? No, your business is inefficient because you are not able to clear the inventory. Anyway, net working capital, even if it is negative, it's okay, because you are blocking someone else's money more than what someone else has blocked your money. So net working capital, if it is negative, fine, but working capital at the whole should be a positive number. Fine. Okay, talking about liquidity ratios, current ratio we already discussed. Now quick ratio, in numerator only consider those items which can be quickly converted to cash. Cash plus marketable securities plus receivables. I don't include inventory. What is the guarantee? Inventory will be sold quickly. Okay, and denominator same, current liabilities. Quick ratio is also called as acid test ratio. Okay, just some jargon, if they ask you in the question you should know. Cash ratio only include those items which are which short can be converted to cash immediately. Cash plus marketable securities upon current liabilities. Here I don't even include credit debtors. What if they default? What if they turn into bad debts? Like that. And moreover, credit debtors, my debtors, they would be given a certain credit period. What if I need the money quickly? Can I tell them to pay faster than what I have given them? So that's not possible. That's why we exclude debtors also in cash ratio. Denominator remains the same in current quick cash ratio everywhere. Now talking about solvency ratios. Is solvency ratio a part of this chapter? No. So we do not discuss solvency ratios right now. Then we will discuss it at the appropriate place in FSA. Anyway, now we had discussed efficiency ratios. Debtors turnover ratio, respect disrespect method, you remember debtors turnover ratio, sales upon average receivables. Why do we take average? That also we had discussed, because it's a mixed ratio, timing mismatch, recall all that. Debtors turnover, thereafter number of days of receivables, also called as days sales outstanding. 365 upon debtors turnover, days sales outstanding, lower the better, means you are recovering money faster from your debtors. If days sales outstanding is less, your debtors turnover ratio would be high, okay, which is desirable of course. Similarly, same logic, inventory turnover ratio, higher the better. Turnover means what? Number of cycles in a year, remember? Okay. Inventory turnover ratio is what? COGS upon average assets. Please do not take sales, because inventory is linked to what? COGS upon average inventory, okay. Again average inventory, because it's a mixed ratio. Number of days of inventory on hand was what? 365 upon inventory turnover ratio. Lower the better. Lower means what? You are taking, you are able to clear, the business is able to clear inventory faster. That is what is the interpretation of number of days of inventory on hand. Creditors turnover ratio, purchase upon average creditors, lower the better. And days payable outstanding, higher the better. You are taking more time to pay your customers, which is what is desirable. Okay, fine. Now coming to operating cycle. Operating cycle was what? Days sales outstanding plus days of inventory on hand. The moment you subtract days payable outstanding from this, you get cash conversion cycle. Again speaking, both operating cycle and cash conversion cycle, lower the better. Definitely you want your money to be converted back to money faster. Okay. Can cash conversion cycle be negative? We had discussed that. Yes, absolutely possible and desirable also. You are getting to utilize funds free of cost. Okay, Hindustan Unilever example we had discussed, it has a negative cash conversion cycle. Okay, fine. Now we had discussed one working also, effective annual rate of vendor financing, whether to go for that or to go for a bank loan. Logically I had explained you the entire formula, if you remember. 2 by 10 net 30. What is the interpretation of this statement? In any case you have to pay your creditors within 30 days, but if you pay within 10 days you get additional 2% discount. So we had done a calculation whether it is worthwhile to take this discount or it is okay to forgo this discount, right? Okay. Now this was the formula. Effective annual rate 1 plus the discount upon 98. Again, I won't expect you to remember the formula. The way I had explained it logically, if you remember that way, you can construct the formula on your own. And to the power 365 by 30. 365 because I want to annualize, 30 because that is the time period for which I get to utilize the funds in case if I wish to forego the discount. Now, foregoing the discount is as good as a cost involved to the company. You can consider it as an interest cost. So like that. Clear? Oh, sorry. How many days I am utilizing the funds additionally for? So it will be 20. Thanks for the correction. Yes, I had discussed that. Okay. T-shirt example I had given, if you remember. Fine. So if say for example your effective annual rate comes out to be 20% and bank loan is available at 8%. So you take the bank loan at 8% and avail the discount offered by creditors. You would be better off in that, right? If you forgo the discount offered by creditors in that greed of using the money for 20 additional days, you will have an effective annual cost of around whatever the percent comes out to be, assuming 20% like that. Okay, fine. Yes. Of course, -1 into 100 finally to calculate the percentage. That is implicit now, that you should know. Okay. Drags and pulls on liquidity. Drag on liquidity means what? Money coming in slower. Pull on liquidity means money going out faster. Is any of this desirable? Not at all. We want the opposite. Money coming in faster, money going out slower. Like that. Okay. Then we had discussed primary and secondary sources of liquidity. Primary sources of liquidity is liquidity obtained from your normal business operations, from your receivables, from sales and all that. Secondary sources of liquidity is when the company may be facing some difficult times, selling long-term assets, renegotiating debt contracts with the creditors, asking for extra payment period from the suppliers. All that is what secondary sources of liquidity. Fine. Aggressive and conservative working capital management. I had told you one story of IL&FS. It was borrowing for short term, lending for long term, but that was not the proper way of doing business. Yes, what is more desirable? Stability is desirable. Had IL&FS borrowed for 10 years, it could have lent for 10 years. Easily stable in a stable manner, but stability always comes at a cost. What IL&FS was doing was classic example of aggressive management. If you are going for conservative management, working capital management, it will be expensive, but it will always ensure stability. Now, to take one example, I have a lot in cash and marketable securities. Now I'm getting restless because here I'm incurring opportunity cost. Now cash won't give me anything. I'm incurring opportunity cost by just holding cash. Marketable securities hardly gives me any interest. Now I sell all that. I convert my cash into real estate. I sell marketable securities and convert it into real estate because I don't want to incur opportunity cost. Now this is an example of aggressive working capital management. If you would have had the cash and marketable securities, you would have had liquid assets which would have helped you manage your working capital better. Yes, the cost you would have incurred in terms of foregone profits in case of real estate deals and all the rental income and all that, but that stability would have helped you somewhere or the other, like that. So again, it's a business call whether a business wants to have conservative working capital management or aggressive working capital management. Conceptually, I hope you have understood this. Okay, fine. Anything in this chapter? Now discussing capital investments and capital allocation. Starting off with the types of projects. Going concern projects, little thought, easier and faster execution. And then expansion projects, lot of thought and slower execution, lot of thinking and all that you have to do. Going concern projects may replacing your existing machinery with a new machinery. Compliance projects you have to do if you want to undertake that project. It's a regulatory requirement. So how much ever you think about it, unless you undertake the main project, then compliance project is gone, but otherwise it is compulsory, never optional. Then talking about expansion projects, it could be expansion into new geography or expansion into new products. A lot of thinking will have to be done. Okay. Now discussing about the steps, capital allocation process. First is what? Idea generation. Then is what? Second is analyzing project proposals. Third is what? Creating the firm-wide capital budget. And fourth is post-audit, to see where you have gone wrong. Because see, when you do capital budgeting, it is based on what? Estimations or actuals? Estimation. The future cash inflows are purely an estimation. Earlier, when you don't have any experience, your forecast could be way off balance. Then once you get proper experience, knowledge and all, you could make appropriate forecasts. I'm not saying exact, but actual, close to actuals, like that. And that step will be known only in post audit. That correction of mistakes can happen only in the post audit step. Now NPV calculation I had taught you, calculator shortcut CF function, NPV calculation. Which project should you undertake? Positive NPV projects, definitely. Okay, the discounting happens at what? The WACC, which is also called opportunity cost of capital. If the project NPV is positive, can I say the IRR of the project exceeds the WACC? You are able to meet your cost of capital. That is when your project is generating positive NPV. At an NPV of 0, IRR is exactly equal to the WACC. And if the IRR is less than WACC, means your project is loss making. So your NPV would be 0, negative. It would be not even 0, it would be negative, right? Okay, fine. Now, given a choice between two mutually exclusive projects, mutually exclusive means what? Undertaking one project means you cannot undertake the other project. If you had to choose one project out of the two, would you choose a project with higher NPV or higher IRR? Higher NPV. We had discussed multiple problems with IRR. Now, problem number 1, a project can have multiple IRRs, and especially that project which has unconventional cash flow. Only that project which has unconventional cash flow pattern. Unconventional cash flow pattern was what? The signs are changing more than once. Initially outflow, then inflow of money, inflow of money, inflow of money, then outflow, then inflow. This is unconventional cash flow pattern. So unconventional cash flow pattern projects can have multiple IRRs. Now what to trust? I had shown you some numbers. Now how absurd was that? That project had two IRRs. One was 0%, one was 62%. Unbelievable, but that's how it is. Second problem with IRR is that it assumes the reinvestment at IRR. I had shown you the entire calculation. Now that IRR of the project in our lecture was coming out to some 120%. Now how could you realistically think that the project cash flows could be reinvested at 120%, right? Okay. And what else? Percentage and absolute returns. Always focus on the absolute numbers. IRR, I had told you, wow, one guy has achieved 100% returns, but his capital was how much? 100, which has grown to 200. Now tell me, is it a big deal? No, like that. Okay, fine. So always choose projects with higher NPV. Also, I am choosing a project with NPV, and the IRR of that project is say 14%. Cost of capital WACC is say 12%. So it is exceeding the WACC, fine. But the firm might be having some hurdle that the project IRR should cross 16%. So even though my IRR is exceeding the WACC and my project NPV is positive, still I do not undertake that project just because it is not exceeding the hurdle which the firm wants. ROIC, remember, return on invested capital. Very important concept. Return on invested capital is net operating profit after tax which is technically EBIT, net of tax, upon average capital invested. Now guys, please consider that capital only which is long term in nature, long term debt and equity, which is typically used for the project. Okay. Now ROIC can be written in one more way. It's a multiplication of two things, if you remember. EBIT net of tax upon sales into sales upon average capital invested. Now which is the first ratio? What is the first ratio called? EBIT net of tax upon sales is the operating profit margin, and the second ratio is called what? Capital turnover ratio. So can I say ROIC is a multiplication of these two ratios? Now you get to have a better understanding. Okay, the ROIC is driven due to what? Is the ROIC high because of higher operating profit margin, or is it high because of higher turnover, capital turnover? You get to know that detailed breakup, and it is more effective like that. Okay. Now talking about principles of capital allocation, very important, which you have to consider in every project. Should you consider the sunk cost or ignore? Ignore sunk cost, because irrespective of whether you undertaking that project or not, those costs would have been incurred, like that. Do you have to consider externalities or ignore? Consider. Two types of externalities, positive, negative. Positive externalities is when the launch of new product will help the sales of existing products. Negative externality is when the launch of new product will hamper the sales of existing products. Please consider that. Negative externality is also called cannibalization. Should you base your project decisions on cash flows or accounting income? Cash flows, because accounting income is subject to manipulation, and moreover accounting income, net income, is based on accrual method. So even if cash has not been received, I can still show it as sales. So what matters is the cash flow. Tell me, after tax cash flows would matter or before tax? After tax, after considering all your expenses and everything, after payment of taxes, whatever is left in the project, whatever is left for the company. Also tell me one thing, interest. Do you have to consider interest separately? I discussed this specifically. The project cash inflows which you have, you will subtract all your expenses, overhead, direct expenses. Do you have to subtract interest expense? Because already adjusted in WACC. If you consider it separately, it will amount to double counting. So please, it is already included in WACC. Don't consider it separately. Okay, fine. Timing of cash flows, is it important? Definitely very important. Earlier the cash flows, more could be the IRR and more would be the NPV, right? The later the cash flows in a project's life, reverse effect. Okay. Now errors in the project forecasting and all, poor forecasting, considering whatever I discussed, opposite points of that, considering net income instead of cash flows, considering sunk cost. These are all the pitfalls, all the mistakes that you do in the capital allocation process, not accounting for externalities. So whatever is the right, all the opposite of it will be the pitfalls in capital allocation process. Makes sense? Okay, some could be senior pet projects of senior management which are not good for the company as a whole, but because the senior management wants to have that, they will do it, which may not be value additive for the shareholders. Like that Dubai example, remember? Okay, fine. Now when it comes to options in a project, is having options valuable? Yes, perhaps options could be valuable for the project. So NPV of a project with option is NPV of project without option. Plus value derived due to the option, value of option, you can write it value of option minus cost of the option, right? Okay, fine. Proceed. Now when I discuss about options, how do you determine the cost of the option? Using the Black-Scholes or any other option pricing model, right? Okay. Now which are the types of options? Timing option. The company gets the option to start the project at an opportune time. It can delay the project by 1-2 years or whatever time it wants. Abandonment option. The company can stop the project midway in order to avoid further losses. Okay, it is valuable to the company. Then we had discussed expansion option. Yes, expansion option is where the company gets an option to expand the project, and it will exercise that option only when it is valuable to it, definitely, when it sees the value exceeding the cost. Then we had flexibility options. In that we had two: production flexibility, making workers work overtime and all; price setting flexibility, charging whatever price I may want, like that. And finally we had fundamental options, the projects which are themselves options. We had taken the example of a mining business. Mining is a cyclical business, we all know that. So accordingly I can decide if I want to mine it or no, which the OPEC keeps doing. Organization of Petroleum Exporting Countries, whenever the demand for oil is less, the price of oil would be less, so they don't pump in that much oil in the market. Whenever demand for oil is more, that time also they can create an artificial scarcity to increase the prices, like that. So depending on however it favors them, it could play around, right? Okay. So these were the various types of options. Anything in this that you need to know, this chapter? Capital structure, relatively longer chapter. Okay, WACC, weighted average cost of capital. So first I had made you do this chapter, if you know. So then you can understand capital budgeting because you would be knowing WACC by then. So weighted average cost of capital is what? KD, cost of debt. But what, before tax or after tax? Because you get tax benefits into weight of debt, plus cost of preference shares if any into weight of preference shares, plus cost of equity shares if any into weight of equity shares. Equity shares if any, it will definitely be there in the business. Debt or preference shares may or may not be there, right? Okay. Now the way you determine cost of debt is straightforward compared to determining the cost of equity. Okay. And cost of preference shares is the simple dividend rate. Fine. Cost of equity, implicit cost or explicit cost? Implicit cost. Cost in the form of shareholder expectations. We had discussed that. Dividends are optional, they are not mandatory, so it cannot be an explicit cost. Debt, cost of debt and cost of preference shares always explicit cost, mandatory, predefined like that. Fine. Okay. Most important, market value weights or book value weights? Market value weights. Okay, because that reflects the economic reality better if you want to calculate WACC at a particular date. Okay, going further, we had discussed various stages of a business's life cycle. Startup stage, heavily equity financed, then comes the growth stage, and finally matures. As you go up above the stage, the debt levels can increase because the company is in a better position to handle the debt on its balance sheet and meet the interest obligations. Now, whether or not the company is able to, how much is the company able to meet the debt obligations and all, you calculate coverage ratios, interest coverage ratios, debt to equity ratio and all that stuff to check the solvency position of a company. Fine. Now they have discussed the difference between debt and equity. Of course, we have discussed that multiple times, and this is the most basic thing you should be knowing by now. So that I'm not discussing. Okay, fine. Coming to structure, Modigliani Miller, proposition 1, no taxes, and this proposition 1, entire theory had taken such simplifying assumptions: no taxes, no transaction cost, borrowing and investing at risk-free rate, rationality of investors. What a joke. Okay. Now proposition 1, capital structure irrelevance. Tell me, between two companies, company A 30% debt, 70% equity, company B 70% equity, 30% debt. Array, same, sorry, 70% debt, 30% equity. Which company will have a higher value? As per proposition 1, both companies will have same value, but deep inside your heart you know that company B will have a higher value. I'm not considering any cost of financial distress and everything, but purely from a theoretical perspective, company B will have a higher value just because it has more debt on its capital structure, keeping all other factors between the two companies same. Okay, fine. Now proposition 2 is, first is without taxes. What was the underlying message of proposition 2 without taxes? As you increase the debt in your capital structure, the cost of equity would increase because equity holders will start feeling more and more insecure because the company is increasing the risk. But then your WACC as a whole would remain unchanged at whatever level of capital structure you operate. 30% debt, 50% debt, 70% debt, 80% debt, WACC would remain unchanged. Remember that formula, cost of equity is equal to cost of equity when it was fully equity financed plus debt to equity ratio, cost of equity when it was fully equity financed minus cost of debt. That was the formula to determine the cost of equity. Fine. That was the message. Now message of proposition 1 and proposition 2 without taxes is the same, but the way they have presented it differs. Proposition 1 talks from a firm's value perspective. Proposition 2 without taxes focuses more on WACC. WACC remaining unchanged. Proposition 2 with taxes. What was the underlying message? As you increase the debt level in your capital structure, the cost of equity would increase. and your WACC as a whole would keep on reducing at every successive increase in the debt level. And why was that possible? Because of tax benefits on additional debt. So theoretically speaking, as per proposition 2 with taxes, the firm value is maximized at 100% debt level because of the tax benefits. But then realistically speaking, what will come in after a point of time? Financial distress. So there has to be an optimal capital structure. Optimal capital structure is that level where the firm value is maximized and WACC is minimized. If you take on debt beyond the optimal capital structure, your costs of financial distress will eat you up and your firm value will keep on reducing. Now it is difficult to calculate the value of financial distress. If at all they give it, if at all they mention it, they will give it to you in the question. Okay. So value of levered firm is equal to, levered firm means what? The firm with debt is value of unlevered firm without debt plus tax benefits on the debt minus present value of costs of financial distress. Okay, this theory was, there was a name to this theory, optimal capital static trade-off theory, which is realistic in nature. Okay, fine, it makes sense. Now talking about target capital structure, I had discussed a lot on target capital structure, that you should be considering book value weights when it comes to target capital structure, and we discussed the reasons also why. Now I'm not going into that much depth right now. If as an analyst you don't know the target capital structure, there were 3 ways to calculate the target capital structure. See what is the current proportion of debt and equity at the book value weights. Okay. Second was what? Peer comparison. You take the peer, see their debt to equity levels and take an average. And third one was what? Past trends. That's correct. Past trends. If I am observing a noticeable trend that from the past till today the debt levels have increased at a particular rate, so I will accordingly consider that as the target capital structure. Now when it comes to determination of WACC for target capital structure, as such we use market value weights, but for WACC using the target capital structure it will be book value weights. That thing you need to consider. Now not going into the reasoning, already discussed that, fine. Talking about information asymmetry, there will be some signals as a firm you shareholders may perceive what the firm is giving. We had called that pecking order theory. Which is the best sort of signal if I want to undertake a new project? Which will give you the best signal as shareholders? Me using, the company using internal funds. By the way, when I talk about internal funds, is that free of cost? No, that is ultimately shareholders' money. Shareholders do expect something on it. So just because internal funds is just lying in the business doesn't mean it is free for the business. There is a cost attached to it. So please do consider that cost also in your WACC calculation if at all they give it to you in the question, right? Okay. Anyway, internal funds, best signal, followed by new debt, and last new equity. New debt, why on second number? Because it signals that the firm has confidence that it will be able to satisfy the interest obligations, and new equity signals the least confidence in the management's abilities, that the management are themselves not confident that first of all they don't have internal funds, secondly they may not be able to service the debt. And these are some theoretical assumptions and not necessary. Because the management has issued new debt, it doesn't have confidence. We had discussed the reasons what would trigger management to issue new equity, new debt. Maybe because it wants to take advantage of the market fluctuations in equity share price. If the share price has shot up significantly, it may be tempted to issue new equity at the higher price. I had shown you the numbers. And if the debt is available cheaply, it may see it as an opportunity to issue new debt. That doesn't mean it is sending any bad signal. Maybe it must be a strategic decision of the company, like that. Okay, do you recall all this? Fine. Agency costs of equity. There is information asymmetry between managers of the company and shareholders. So to minimize this information asymmetry, shareholders incur what? Agency costs of capital in the form of bonding costs. giving good compensation and all to the managers, non-compete agreements, appointing auditors, other external analysts, etc. to see whether the functioning of the business is going on properly. Okay, fine. Then, despite incurring all these agency costs, is there a guarantee that everything would function properly? Still, there could be some residual losses, residual costs, yes, which you cannot fathom or know in advance or can factor in, right? Okay, unknown ones. Free cash flow hypothesis was what? Taking on some level of debt is healthy so that managers will not misuse the money. First, they will be obligated to repay it to the debt holders. I had given you one example, home loan, don't want to close it so early, otherwise a person may lose the motivation to work. Remember that is exact example of free cash flow hypothesis. Fine? Okay. Anything else in this chapter? Pecking order theory I already discussed. Business models. Okay, business model should identify the firm's potential customers. Okay, who does the firm serve to? What is the channel strategy of the business? Direct or maybe through some intermediary, like that. Omni channel is what? Offline plus online both. A business could be either offline only or online only or both, like that. Okay, now key assets and suppliers of the business. Key assets for IT companies, assets could be what? Employees, any maybe patents. For pharma companies, it could be patents, like that. So that it has to define. Okay, then by the way, forecasting and all, models and all never form a part of the business model. Forecasts, financial forecasts, that is to be seen separately. Okay, unit economics is important to be seen in a business model. What is the per unit cost? We had taken the example of Zomato, unit economics when it started off, and until few months back it was negative. Matlab per order it was making losses. And why was that? Because delivery charges and all were exceeding as compared to the commissions that it was getting. Okay, fine. Now discussing about pricing strategies. One is cost based pricing, one is value based pricing. Cost based pricing is the cost which I have incurred as a business plus profit margins. Value based pricing is I won't see the cost but the perceived value derived to the customer. Louis Vuitton, Gucci, all that, value based pricing. Now there are several pricing strategies and we had taken a good amount of time to discuss just the pricing strategies. Price discrimination was what? Tiered pricing. The more products, the more volume you buy, the more discounts you will get, which we typically call a trade discount. Fine. Then comes your dynamic pricing. Uber example, surge pricing. Dynamic pricing, by the way, is also called surge pricing. During peak hours, it charges higher prices. Airlines, classic example of dynamic pricing. Okay. Then value based pricing, so we already discussed. Auction pricing, eBay example we had taken, auction pricing. Mining rights and all also are through auctions, right? Okay. Now pricing models when it comes to multiple products. Bundling. Bundling mein I bundle all the products and sell it as a package. Kia example we had taken, Kia Motors. Then add-on pricing. Add-on products would be optional or compulsory? Optional. Add-on pricing is optional. Okay, fine. Thereafter, razors and blades strategy. Amazing strategy, razors and blades. We had taken the example of a Gillette Presto razor and blade. Sell the product which is going to be repeatedly bought at a higher price and sell that product which is going to be once bought at a lower price. Pata hai that razors, blades are going to be repeatedly bought, sell them at a higher margin. I had given you the example of printer and cartridge. Printer, sell it at a low price knowing that customers would then definitely come to buy the cartridges. So cartridges may you can have higher margins, like that. Okay. Penetration pricing, introducing the product at a very low cost, knowing that we will make losses but we want to capture the market share. Geo example we had taken, low cost nahi, it is free and it captured the market share. Then to recover those losses, it slowly kept on increasing the prices. Okay. Thereafter, freemium pricing. Some features of the product will be available for free. If you want premium features, you have to pay a price for it. Spotify example we had taken, Bumble, Hinge example we had taken. Okay, fine. Hidden revenue. So remember, when something is free, you are the product. Instagram, Facebook example we had taken. Hidden revenue. Okay, how do they earn money? By selling your data and flashing ads. Okay, fine. Hidden revenue example is one more, ClickBuzz. ClickBuzz also, it's subscription model also, but you are using ClickBuzz for free. Now, how does ClickBuzz make money? You can see ads on ClickBuzz, the cricket app. So there it is getting money from there. And now it has introduced premium plans and all. Earlier, though, it was hidden revenue model only, like that. Okay. Now, subscription model, we had taken example of Netflix, and then licensing and franchising. We had discussed licensing, franchising. We had taken example of MACD, franchisor, franchisee, two parties. Now, between licensing and franchising, we had discussed the difference. It may seem similar, but there is a difference. In a franchising, I am the franchisor, you are the franchisee. Will my control be there as a franchisor? Will MACD, the main brand, tell the franchisees how to prepare the burgers and all? Of course, it has to have that control in order to maintain the product quality, taste and everything. But in case of licensing, that free hand would be given. Okay, fine. And then what, as a franchisor or as a licensor, what do I get from the licensee and franchisee? Royalty. Okay, fine. Now, value proposition and value chain. Value proposition is what? Whatever benefits the customers derive from the product, whatever you find something good about a business, that is basically a business's value proposition. Say for example, I had taken the example of Amazon. I just love the way they have this return policy, absolutely seamless, no questions asked. So this is what I find the value proposition about Amazon. You may find something else about Amazon. Okay, maybe the range of products available and the kind of transparency shown, the kind of detailing given about the products, that could be the value proposition. Value chain matlab right from the start to end, whatever steps are involved internal to the firm, inbound procurement, processing on that, inbound procurement, inbound logistics, operations, then what? Outbound logistics, marketing, after sales service. Very important, after sales service, because it is easier to retain existing customers than to acquire new customers. So after sales service, you have to give good service, definitely. Then private label manufacturers, contract manufacturing, which we had discussed, job work, that is private label manufacturing. Okay. Licensing agreements, again it is getting repeated. And your network effects, very important. One-sided, two-sided network effects. Skyscanner, two-sided network effect. The airlines will benefit if there are more number of users. Users would benefit if there are many airlines flashing their services. Skyscanner example we had taken. Zomato example we had taken. There are so many examples. Uber, yes, completely agree. Uber, more the cabs, more the options available, more availability, and more the users, the cab drivers also have more business. Yeah, okay. Then your crowdsourcing, Wikipedia and all, as such it is giving it for free, but then if you donate something and all, on the basis of that it can make. Medium I had taken. Medium is a better example of crowdsourcing. Medium, you write articles and all, you contribute articles to Medium, they will pay you for that. YouTube also is an example of crowdsourcing. You contribute content and YouTube will pay it to you, like that. Customers and all won't pay, they will buy premium, but that revenue goes to YouTube, like that. Getting it? Okay, fine. Then I had discussed one more thing, but it was out of curriculum, so wouldn't like to bother you with that. Uber pricing, Uber ka example, Unacademy and Byju's ka example I had given. Aggregator is when someone sells that product under that brand's name. Uber is an example of aggregator. Unacademy and Byju's, Unacademy is an aggregator. If you want to purchase lectures of a professor and all, you can go to Unacademy, but then Unacademy will sell it, marketing and all will be done under Unacademy's brand name, right? Not under professor's personal brand name, like that. Getting it? Okay, fine. But aggregator concept, I think they have removed it. Now it's no longer there. Fine. Okay. Anything else in business models? Fine. Are we done?